Hey Aussie investors, if you are just starting to explore the world of shares and ETFs, there is something unique to Australian finance that you need to know about: franking credits. This can really give your investment an extra boost. Today we are going to dive into what franking credits are, how they work, and their impact on your investments and tax returns. Let's get started. So, what exactly is franking credit? Let's break it down with a simple example. The company you invested in makes a profit of $100 and pays the ATO $30. This is due to the 30% corporate tax rate. All companies in Australia are subject to a tax rate of 30% on their taxable income, except for small or medium business, which are subject to a reduced tax rate of 25%. However, to keep our example simple, let's use 30% and assume you are the only shareholder of the company. The company decides to pay you the remainder of the profit, which is $70, in the form of a dividend. From the shareholder's perspective, you receive a payment of $70 in your bank account. But that's not the end of the story. Somewhere in the background, a 30% tax credit is also allocated to you. This is a tax the company has already paid to the ATO, and it is known as the franking credit. So at tax time, you will declare your dividend income of $100, which is the total of the dividend payment and the franking credit, and pay tax on this based on your marginal tax rate. If your marginal tax rate is 30%, you don't need to pay any more tax due to the $30 franking credit. In other words, the tax has already been paid by the company on your behalf. If your marginal tax rate is less than 30%, for example 19%, you will get a refund because the company has overpaid tax on your behalf. If your marginal tax rate is more than 30%, let's say 45%, you will need to pay extra tax because the company has not paid enough tax on your behalf. This concept is similar to the pay-as-you-go system used for individual income tax in Australia. In the pay-as-you-go system, when you receive your salary from your employer, it's not the total amount you earned. That's your gross salary. Instead, what you receive is your net salary, which is your gross income minus the income tax that your employer withholds and pays to the ATO on your behalf. In both cases, whether you are dealing with dividends and franking credits or salary and pay-as-you-go tax, the principle is the same. The income reported to the ATO is the total amount before tax. Any tax already paid, whether it's by a company on your behalf for dividends or by an employer on your behalf for salary, is taken into account to balance everything out when you complete your tax return. This ensures that you are taxed accurately according to your total income, not just the money you physically received. Not all company pays dividends in the same way. There are fully franked, partially franked, and unfranked dividends. Fully franked dividends means that the company has paid the full corporate tax rate of 30% on its profits. Partially franked dividends are when the company has only paid tax on part of its profits. And unfranked dividends are paid without any tax being paid by the company. To find out what type of dividend you're receiving, check your dividend statements or look up the information on the ASIC website or the company's investor relations page. Now we understand the different type of dividends. Let me show you a simple way of calculating your franking credit, no matter what type of dividend you receive. For this, we will use a handy online calculator. You can find the link in the description below. Let's walk through how to use it. First, enter the amount of the dividend you received. Next, you will need to know the franking level of your dividend. 100% for fully franked. If you receive a partially franked dividend, adjust the franking level accordingly. For example, if it's 50% franked, set the level to 50%. For unfranked dividend, set it to 0%. Once you input these details, the calculator will do the rest. It will show you the gross up dividend, which is the total amount before corporate tax, and the franking credit you are entitled to. This makes it super easy to understand what you will report on your tax return. When it's time to do your tax return, what you report as your income is the grossed up dividend figure, and you enter the franking credit amount as refundable tax offset. If you find this video helpful, please like and subscribe for more practical financial tips. Thanks for watching. See you next time.